Okay, in the second part of this chapter, we are going to examine operating leverage of a company and the effect operating leverage has on a company's profitability. Now, to understand operating leverage, you must understand cost structure. Cost structure is the relative proportion of fixed costs versus variable costs that a company incurs. That is, a company consciously decides how much of its costs should be fixed and how much should be variable. And that decision has a significant effect on profitability. So choosing your cost structure very carefully is important for businesses. For example, let's use an illustration. Vargo Video and one of its competitors, New Wave Company, both make the same product. Vargo uses traditional labor-intensive manufacturing process. That means a lot of direct labor. Direct labor is variable. Whereas New Wave Company is invested in machinery and they have an automated system. So therefore, if you have an automated system, you invested heavily in machinery and therefore you have fixed costs. So when you look at these companies, they both have the same sales. Okay? But the variable cost for Vargo, because it has more direct labor, is higher. The contribution margin is $320. For New Wave, the variable cost, because of machinery and depreciation, is lower. So the contribution margin is higher. Now the fixed cost for Vargo, because it's labor intensive, is low, and the fixed cost for New Wave is very high. So this is their cost structure. The amount of variable cost and fixed cost in the structure for Vargo, that is high variable, low fixed. For New Wave, it's low variable, high fixed. They both have the same profit. Now let's examine the two companies. First, let's look at the relative contribution margin ratios. Now remember, the ratio is that percentage of contribution margin is of sales. So therefore, for Vargo, the contribution margin is $320 and sales is $800,000. For New Wave, it's $640 divided by $800,000, which equals 0.440. And here it's 0.80. So there's the contribution margin ratio for these two companies. What does that mean? Contribution margin ratio 0.4 and 0.8. What it means is that New Wave contributes 80 cents of net income for each dollar of increased sales. So when I increase my sales by $1, profit will go up by 80 cents. Vargo, it would only go up by 40 cents. Now this is beyond the break-even. New Wave's cost structure relies highly on fixed costs, more sensitive to change. But once both companies are beyond break-even, you can see that New Wave is making twice as much profit as Vargo because of their cost structure. Now what's the effect on the break-even? Well, let's take the fixed costs. Remember, the fixed costs for Vargo were $200,000. And the New Wave, the fixed costs were $520,000. Contribution margin ratio for Vargo was 0.4, and the contribution margin ratio for New Wave was 0.8. So therefore, the break-even in dollars for Vargo, it's $500,000. But for New Wave, it's $650,000. They have to sell $150,000 more just to break even. So New Wave, because that higher break even, is riskier. But once you go beyond the break even, both of them achieve the break even. Vargo is making 80 cents on every dollar, and New Wave is making 80. Vargo is making 40. Now, again, what's the margin of safety? Well, the margin of safety is in favor of Vargo because of its cost structure. Remember, margin of safety is the difference between actual or expected sales and break even. So if we take the expected sales of 800 each year and the break even of in sales of 500, therefore we have a 38%. And that is double or more safe. Vargo is a safer, can sustain a 38% decline in sales before operating loss versus a 19%. So New Wave is very risky. This is the trouble with operating leverage. Your profit goes up twice as fast, but when sales go down, your losses go up twice as fast. So now, the idea of operating leverage. That is the extent that net income reacts to different changes in sales. The higher fixed costs relative to variable costs causes a high operating leverage. When sales revenue are increasing, a higher leverage will give you much more profit. But when sales are going south, the same thing, your losses are going to be twice as big. And therefore, you have one more calculation. Your margin of safety, contribution margin ratio, and all that. We now have something called the degree of operating leverage. Now this is a calculation. You understand the idea. The calculation is simple. You simply take the contribution margin and divide it by net income. So the contribution margin for Vargo, the net income, not sales, net income. And they get a factor called 2.67. New Wave, higher contribution, same net income, and gets a factor almost twice as much. So you see, New Wave's earnings will go up twice as much. For every dollar, it'll go up twice because their degree of operating leverage is twice the degree of Vargo's operating leverage. Now that's what you will be responsible for in this part of this chapter. Understanding what operating leverage is and being able to calculate it.